Ever feel lost when traders talk about futures? You're not alone. Today, we'll simplify this complex concept and decode futures contracts for you. So, what exactly are futures contracts? At their core, they are agreements. Imagine a corn farmer worried that corn prices will drop before harvest. Now picture a cereal company fearing prices will soar. A futures contract allows them to agree on today's price for corn to be delivered later. The farmer secures a guaranteed price, and the cereal company locks in its cost. Both parties sleep easier, protected from price fluctuations. Today, most traders use centralized exchanges like the CME Group to trade standardized futures contracts. These contracts are legally binding agreements to buy or sell an asset at a predetermined price on a future date. That asset could be anything from physical commodities like gold or oil to financial products like the S&P 500 index. Key term here is standardized. Every contract for a specific asset is identical, making trading seamless and efficient. Now, why would you trade futures? There are two main reasons: hedging and speculating. The farmer and cereal company are hedgers. They use futures to mitigate financial risk. Most market participants, however, are speculators. They aim to profit from price changes, buying contracts when prices are expected to rise and selling when they are predicted to fall. So what advantages do futures have over stocks? For active traders, leverage is significant. Leverage allows you to manage a large position with a small upfront investment called margin. This can enhance both your profits and losses. Secondly, futures markets operate almost around the clock, from Sunday evening to Friday afternoon. This flexibility lets you trade at your convenience. Understanding leverage and margin is crucial, but it takes practice, much like learning to ride a bike. For resources and community support on your trading journey, check the link in the description. So, how do futures actually work? Instead of owning shares of a company, you trade contracts. If you're bullish, you go long by buying a contract. If you're bearish, you go short by selling a contract. Contracts fluctuate in value through small increments known as ticks. Each tick carries a specific dollar value. For example, the Micro E-mini S&P 500 contract has a tick size of 0.25 points worth $12.50. If you buy one contract and the price moves up 1 point, you've gained $50. For beginners, micro contracts are perfect. They allow you to trade with just 1/10 the capital of standard contracts, minimizing risk as you start. Your account balances are adjusted daily through a mark-to-market process. Gains are credited and losses are deducted. Traders typically close positions before expiration by selling the bought contract or repurchasing the sold one. So what's the main takeaway? Futures are contracts to manage risk or speculate on price movements. They provide leverage, nearly 24-hour trading access, and entry to diverse markets. Remember, with potential rewards come real risks. Don't rush in blindly. Consider starting with a simulator account at a futures broker. It allows you to practice with real market data without any financial risk. If this video helped clarify futures for you, don't forget to subscribe for more informative guides on your trading journey. Want to learn day trading with the best software? Check the description for more.